For the first time in Canadian history, our population is actually shrinking, and it's happening at the exact same moment that banking regulators are warning up to 150,000 homeowners could face serious mortgage stress at renewal. Today, we're unpacking what these two trends have in common and what they mean for your financial life. Welcome back to the Daily Brief Canadian Macro. I'm Steve. Today, we're covering four major developments shaping the Canadian economy right now. Harvard economist Kenneth Rogoff is warning about the biggest global supply shock since the 1970s. Market Mania has the numbers on Canada's historic population decline. Mark Mitchell breaks down exactly who's getting trapped by the mortgage renewal crunch. And Alex McFayden takes apart the government's latest housing package to see who it actually helps. Let's get into it. We'll start with the global backdrop because it sets the stage for everything else. On the David Lin Report, Harvard economist Kenneth Rogoff argues we're in the middle of the biggest supply shock since the 1970s, driven by ongoing conflicts affecting oil, energy, fertilizers, and helium, plus the direct cost of war itself. Here's why that's particularly tricky for central banks. Supply shocks push inflation and interest rates higher at the same time, which takes away the Bank of Canada's usual recession-fighting tool of cutting rates to stimulate growth, getting squeezed from both sides. Rogoff also flags something worth watching on the currency front. Iran is now demanding ship tolls be paid in Chinese yuan rather than US dollars. He notes China's trade invoicing in yuan has jumped from essentially zero in 2010 to around 50% today, and argues the US dollar may have peaked about a decade ago by several measures. Longer term, he sees rising US debt potentially forcing what he calls burst inflation or even selective default. It's worth pointing out here that while Rogoff's dollar decline thesis is a legitimate school of thought, it's also been predicted prematurely many times. The US dollar currently remains the dominant global reserve currency by a wide margin, and many economists argue its structural advantages. Deep capital markets, legal institutions, and military backing are harder to displace than the yuan's share of trade invoicing suggests. That said, the direction of the trend is real and worth monitoring, especially for Canadians holding US-denominated assets or businesses exposed to cross-border trade. Now something closer to home, and frankly more immediately impactful for most Canadians watching this. Market Mania just put out data showing Canada's population fell 0.25% in Q1 2026, dropping to 41.47 million, a loss of 103,500 people in a single quarter. That's the first recorded annual population decline in Canadian history. What's driving it isn't just lower immigration intake. Market Mania reports that roughly 40% of Canada's top 1% income earners and 30 to 50% of the next 9% are emigrating, predominantly to the United States. The argument is that Canada's cost structure makes it nearly impossible for early-stage entrepreneurs to survive on the $20,000 to $40,000 a year a startup typically generates in its first few years. And public sentiment appears to be shifting too. Bloomberg data cited by Market Mania puts 51.7% of Canadians now wanting fewer immigrants next year, a significant reversal from not long ago. Some important context here though, the 30 to 50% immigration figure for high earners is striking, and it's worth being cautious about how it's measured. Immigration data has historically been difficult to track precisely in Canada, and Statistics Canada has acknowledged gaps in its outflow methodology. The trend of high-income emigration is real and documented, but the exact scale should be treated as an estimate. Additionally, some economists would push back on framing lower immigration as a solution. Canada's healthcare, pension, and housing construction systems all depend heavily on labor force growth, so a population decline creates its own set of pressures. For everyday Canadians, this matters in a concrete way. Fewer working-age taxpayers supporting existing public services means either higher taxes, reduced services, or both. And if high earners and entrepreneurs are disproportionately the ones leaving, the tax base shrinks faster than the headcount does. That brings us to the housing market, where Mark Mitchell has been digging into what Canada's banking regulator OSFI is actually warning about, and it's more specific than most headlines have captured. OSFI says between 30,000 and 150,000 mortgage holders who bought after October 2021 will face what Mitchell calls renewal stress. Here's the mechanical problem. Anyone who bought at peak prices with 20% down has seen values fall enough that their loan-to-value ratio is now above 80%. That means they can't refinance with a new lender. They're locked in with their current bank, which can offer non-competitive renewal rates because the borrower has nowhere else to go. Mitchell's example is concrete. Someone who bought an $827,000 home in January 2022 with 20% down now sits potentially at an 88% loan-to-value ratio. In Toronto, the situation is even more acute. Anyone who purchased after August 2021 is effectively in the same trap. However, homeowners in Alberta and Quebec, where values have held up better, may not be facing the same situation. Regardless, the current real estate downturn, while regional, breaks what Mitchell describes as the previous Canadian cycle. Buy with 20% down, spend freely for a few years, then refinance against rising home values to clear accumulated debt. That feedback loop no longer works when values are flat or falling. The broader why it matters here is significant. This isn't just a problem for the homeowners affected. When 30,000 to 150,000 households are paying above market mortgage rates with no competitive option, that's money leaving consumer spending and flowing into lender margins. And as Ray Dalio says, one person's spending is another person's income. Decrease one, you decrease the other. Now multiply that by the broader household debt levels Canadians carry, and it becomes a meaningful drag on the economy, which connects directly back to Rogoff's point about central banks having limited room to respond. So what's the government doing about it? Alex McFayden took apart the latest housing announcement, a $10.5 billion plus package, and argues it's more of a developer bailout than genuine buyer relief. The most tangible benefit for buyers is Bill C-4, zero GST on new homes up to $1 million for first-time buyers, available until 2031, up to a $50,000 rebate. But McFayden flags that the widely advertised $130,000 Ontario savings figure is misleading. On a $500,000 home, the actual new savings is closer to $41,000 because buyers already received a $24,000 HST rebate under the previous rules. The more revealing part of McFayden's analysis is the inventory picture. Toronto currently has 23,000 unsold condos, roughly 5 years of inventory. Vancouver has 2,500 unsold units, a 24-year high. McFayden says this gives buyers serious negotiation leverage right now, with his clients achieving $35,000 discounts on $600,000 properties. The Ontario government also quietly launched a $1.3 billion fund to buy unsold developer inventory and convert it to rentals, which McFayden argues is the tell. If buyers were actually coming back, developers wouldn't need a government backstop for unsold units. It is worth noting that the rental conversion program isn't necessarily bad policy on its own. Converting unsold condos to rentals addresses a genuine supply gap in the rental market. The question McFayden raises is one of framing. Is this being sold as housing relief when it's primarily preventing developer insolvencies? For Canadians, the practical takeaway is this. If you're a first-time buyer, the GST exemption is real money. But understand what you're actually saving versus what's being advertised. And if you're in the market, inventory levels suggest you have more leverage than at any point in recent memory. Step back, and these four stories are really telling one larger Canadian story. Canada is dealing with converging pressures that reinforce each other in uncomfortable ways. Globally, Rogoff's supply shock environment limits the Bank of Canada's ability to cut rates aggressively, which means relief for mortgage holders will be slower and shallower than previous cycles. Domestically, the population decline market mania documents isn't just a demographic curiosity. It shrinks the tax base and labor force at exactly the moment public services are under pressure. Mitchell's mortgage trap means a significant slice of homeowners are locked into above-market rates with no exit, reducing their spending capacity. And McFayden's analysis suggests the government's primary response is protecting developers rather than fixing the underlying affordability problem. The common thread is that the mechanisms Canadians relied on for the past 2 decades, rising home values, population growth, and easy refinancing, are no longer working the way they did. That doesn't mean a collapse is inevitable, but it does mean the playbook that worked for Canadians for the last 25 years needs some updating. Well, that's your brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.